Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, Global Strategist at Yuanta Securities. Mr. Yu, good afternoon. Thanks for making time today.
Good afternoon.
Well, let's start with the markets. Stocks on Wall Street, with the exception of the Dow, continuing the rise we saw last Friday. That, of course, based on remarks by Jerome Powell and others that the Fed could start tapering this year, but won't be in a hurry to raise interest rates. The S&P and the Nasdaq at new highs. What's the story in the global markets?
Right. If you look at the U.S. market, S&P 500 was up about 0.43%. Particularly the Nasdaq was up 0.9%. Now it's breaking well above 15,265. Clearly, the direction seems to be quite strong, where the Nasdaq or the growth stocks are doing very, very strongly. Main reason for that kind of drive is because if you look at the U.S. government rate, the 10-year bond rates now hitting at around below 1.3%. Clearly, the indication is that the interest rate environment is not going to be that aggressive per se. As you said, if you look at the tapering timeline, it could be accelerated probably by the end of this year because they have provided such high level of the asset purchasing program. So the speed of that was 3 times higher than the 2008 financial crisis, and therefore the speed of reduction should be as fast also. However, that does not mean that the central bank will be tightening through the rate hike. If you look at the environment, as we can see, the interest rate environment remains to be very low with 1.3% of 10-year government bond rate, and the inflationary pressure seems to be dwindling down as the month passes by. We think that there's no major reason why the inflation should remain where it is. As the time passes by, as the U.S. economy stabilizes, rather, it was pent-up demand that pushed up the growth rate. But going forward, we estimate that the U.S. real GDP growth rate should remain at around 2.5% per se in a longer-term basis. If that's the case, the pressure for the inflation is not going to be that particularly strong. So having said that, such a low rate environment to be continued in the future means that the growth stocks would look very attractive. So particularly the FANG and MAGA or various these large cap, the tech companies were showing somewhere between 1 to 3% rise yesterday, and that trend can continue to happen as the interest rate environment remains to be very low.
Well, today in Korea, the KOSPI and the KOSDAQ started out quite shaky, but both recovered strongly in the afternoon. On the KOSPI today, interesting to see foreigners buying and local institutions and individuals selling. Tell us about the domestic market.
Yes. If you look at the Korean market, the KOSPI was up very strongly, almost hitting 3,200 territory, rising by 1.75%. And that is because of the massive net purchasing by the foreign investors, total of 1.2 trillion won worth of it. And quite a bit is coming into the Samsung Electronics and the semiconductor industries. The sector of that was the leading sector that made the market to fall, but now foreigners coming back, making the market to go up quite strongly. I guess the local investors were quite perturbed or confused with this kind of movement. We've been saying that as of beginning of this week, if you look at the relative valuation of the Korean market and also the emerging market, it is probably on a relative basis as low as when we saw the Asian financial crisis or the 2001 9/11 crisis. This is the relative valuations or relative price movement since in the last 20 years. So if we are at that kind of low level, meaning that the U.S. market has risen so much versus the Asian market and Korean market, the emerging market did not rise that much, we thought that there's no reason for Korean market to fall further from the current level, but rather towards the end of this year, we could see quite strong recovery of KOSPI as well as the emerging market. So we continue to remain quite bullish on Korea. We do think that by the end of this year, KOSPI can break 3,500 plus, even maybe 3,600 basis on valuations. If you look at the earnings growth rate, it is at 75% this year. The dividend yield is expected to be rising to as high as 4%. All that being said, we think that the Korean market looks very attractive at the current valuation.
Well, shifting gears here, we've seen a spike in oil prices this week because of Hurricane Ida hitting production in the Gulf of Mexico, still below the high that we saw a month and a half ago. And this spike could be temporary, with OPEC plus countries to meet on Wednesday and reportedly planning to stick with a production increase. Where do you see oil prices going from here?
Right. Clearly, the oil price is going to be giving us mixed signals. We've been saying that it should be box trading somewhere between $65 to $75 range, maybe a bit even lower to $60 to $70 range on the basis of demand and supply. As you know, if you look at China, most of the PMI numbers are showing that it is slowing down per se. Also, globally, we're seeing some bit of a modest growth rate expected in the future, which means that oil demand is not going to be that particularly strong compared to 2011 cycle. So if that's the case, with all these alternative energy supplies that are coming through, as well as the shale gas supplies, and also the additional injection by the OPEC plus. All that means is that we think that the oil price cannot go up that much relative to what we saw of about $77 per barrel a few weeks ago. We think that the range bound should happen, and that the demand of the economy should be reasonable, not particularly overheating. Also, it's not going to be to the deflationary environment. So we think that the overall activity should be in a Goldilocks area, period, and that would result into oil price movement of a trading range. So once again, oil price would remain most likely somewhere between $60 to $70 range.
And finally, some economic data in Korea. The fourth wave of the pandemic has hit overall production, notably retail sales declining slightly in July from the month before, though still much better than a year ago. Significant production declines in other areas of the economy, too. So the virus weighing heavily right now. Tell us about that.
Right. I think that when we look at on a month-to-month basis, we are seeing clearly a slowdown, because when we had a very strong recovery post-pandemic, most of the pent-up demand had followed through and resulting into quite strong retail sales number. But as you said, with the COVID variant, Delta variant, people are concerned, and also there's continuation of the uncertainty regarding how fast the spread will happen versus the vaccination speed, how that will be relatively differ. So all being said, we did see month-on-month basis the falling of the retail sales. But nevertheless, if you look at on a year-on-year basis, it is quite strong growth rate of 7.9%. So I think that it's a bit of a more normalization rather than, say, a recessionary or, once again, uncertainties. I think that also if you look at the industrial output as well and construction output, all that indicates that economy is going to be growing at a reasonable pace rather than overheated pace. Also, there is a presidential election next year, so maybe some of these construction output are going to be maybe be delayed, but government is coming out with ample supply of the housing for in the future, and also the economic activity on global scale should be fairly reasonable, with the export numbers remain quite strong. So all that means that industrial output as well as retail sales should be a reasonable pace of growth rate, which means that we think that the overall market should not be too concerned, or the overall economic growth rate should not be too concerned at this point in time.
Got it. All right, Mr. Yu, we'll have to leave it there for today and see how things look again at the end of the week. Thanks so much for sharing your insights with us. We appreciate it.
Thank you very much.